Okay, is the speaker on? Can you hear me? All right. Top of the morning to you all. I'm Lighty Solutions, and with me is Larry Johns of Lighthouse Small Business Accounting, or Business Solutions, I'm sorry. We both want to welcome you to this Kernersville Chamber of Commerce Chamber Academy on Accounting. Before we proceed, I would like to share with you the following disclaimers. Our goal is to provide you with current and useful accounting and tax information, considered full legal, accounting, or tax advice. This information is not intended to be your only source of reference. You should seek the advice of your accountant, tax advisor, or lawyer for any questions you have about your particular situation. We will not be held liable for any legal action resulting from your reliance on this presentation. With that said, let's get on with the Academy Accounting panel. I will lead off with some current client tax issues, bookkeeping, and software. And we hope you enjoy these presentations and look forward to your questions after we finish. Thank you all for attending this Academy today. You all have in front of you, one of the handouts has to do with accounting versus bookkeeping. Out loud, because this should instill questions in you if you're doing all of this. Bookkeeping, so it's who's and who's what. Just remember that. A third party should complete your accounting. Not the word that already knows what's happening. Unfortunately, you're in your trenches looking at your day-to-day job. Okay? Accounting goes beyond the record-keeping functions of bookkeeping. Comparing bookkeeping to accounting is here. Accounting is the process of recording, measuring, interpreting, and communicating financial data. It includes disciplines such as auditing, taxation, which I'll be talking more about today, and managerial accounting. A third-party accountant can help you implement a plan to meet your financial goals and watch for any problems or issues that can arise in your business. Now, more basic that help you track your business. You can complete bookkeeping for your business yourself. Really is what's then supplied to an accountant, all right, for them to really review. Two here now. Okay? Bookkeeping is a support function that includes reporting and you're supporting books and on the tax return. And that's the key, the tax return, because that's the bottom line that the federal government just remember, documents include your sales slips, paid bills, invoices, receipt slips, agreements, etc. Documents should be kept for a minimum of 7 years, and we'll be talking a little bit more about retention of records a little bit later on, and that's just a generic statement, 7 years. And then software, this is kind of a little quick note. Please note that using a software product such as QuickBooks or Peachtree does not replace accounting. That's the bookkeeping function. This type of software is only a bookkeeping system that provides an easier method of recording and summarizing. It's kind of a little reference point, and if you don't have an accountant, I'm not promoting myself, I'm promoting an accountant, period, though I am available if you need an accountant. Just remember that. Okay. Your margin today, we're talking about we're talking about tax rate, which is your personal or a sole proprietorship, and they all flow through your return. So basically, your tax rate that we're talking about is your personal tax rate. Anybody know what their marginal rate is? Okay. Talking about marginal rates, that's not what there are actually two rates when you're looking at taxes. Okay? The marginal tax bracket is what the income for that, okay? I'm going to Now, that's this year, okay? Could totally change, and all bets would be off. But let's look at 6 tax brackets are your 10%, your 33%, and of course, that's not what every tax bracket. And you don't have to write this down because you can go to the IRS. Up much it is. We'll use married filing joint because it could be wrong, but I'll use that one as the example. The first tax bracket you have is your 10% tax bracket. First to $17,000 is taxed at 10%. Okay, so let's assume you earned the $17,400. Your initial tax is $1,740. Okay, well that's fine. Okay, so you pay, and that's on your tax, and that's your net taxable income. That's not your total income. That's after your deductions, itemizations, exemptions. Just remember that. That's your tax at this stage. But let's say you earn $50,000. Okay, well just remember you already have $1,740 in tax. Okay, the next tax bracket's 15%. Okay, that 15% is on anything from $17,400 to $70,700. So in this case, you had $50,000, so you have $32,600 worth of additional tax income at 15%. I'm not going to calculate these out in my head, but just remember that that next group of money is taxed at 15%. And if you made over $70,700, you're in the next bracket at 25. So as your earnings go up, each piece of those earnings are taxed at a different rate. So your last dollar amount, let's say you did earn $70,700, okay? But then you earned another $10. You're in the 25% marginal tax bracket for that $10. All right, so just remember that. But people say, oh man, I'm paying 35% tax bracket. No, that's the marginal rate. Your effective tax rate is what all your income is taxed at. And that's what you look at when you finally get your tax return done. And you see that I had a net income of $50,000 and I paid this much in taxes. That's your effective rate. That's not your marginal rate. But everybody uses marginal rate because it sounds better. It sounds like a lot more tax. But and you've probably heard a lot of the statistics out there, and this is general. I'm not quoting any particular source. But like 50% of Americans don't pay any income tax because of all the exemptions, deductions. This is something that was on the news, evening news the other day, and I'm trying to figure out where they got those numbers. That's not an IRS statistic, so just moving right along there. For that. But the other thing I want to talk about, though, is if you are a C corporation, okay, there's a different set of tax rates for a C corporation. And if you are a C corporation, you potentially could have double taxation. And when I say double taxation, because that's not a flow-through normally. The C corporation, the earnings that you earn in your C corporation, stay in that C corporation, and you have your own marginal tax rates within that C corporation. And particularly, there are actually, if you get into the detail, there are 8 tax rates in the corporate world, but some of those tax rates may sound the same. And I'll go over these real quick for you. There's a 15%, there's a 25%, there's a 34%, and there's a 39%. But then it drops back to 34%. Well, that 34% is on income from $335,000 to $10 million. So most of y'all probably don't fall into that bracket, but just FYI. Then it moves up to 35%, which is up to $15 million. 38%, which is up to $18 million, and 35% again, which is $18 million or more. So they really have a different system there. But let's just say you earned the $50,000 for your business. That's 15%. That's the tax bracket for a C corporation. Okay, you pay taxes on that. Well, let's say you pay yourself a dividend, not a salary, because as a corporation, you can pay yourself a salary as the owner, and you have to pay yourself a reasonable salary. But let's say you take a dividend out of that C corporation. Let's say you want to take $10,000 of that $50,000 out as a dividend to you. Guess what? That goes to your personal tax return, and you pay tax on that at your marginal rate. So in theory, that's double taxation of that income. That's why a lot of corporations, people become an S corporation for flow-through. But if your marginal tax bracket on your personal return is higher, it may not make sense. That's between you and your tax accountant. For that standpoint. But just think about where you're at. Go back and pull out your tax return, and hopefully most of you all filed your corporate returns March 15th or your personal returns April 17th, right? Anybody here have an extension pending? Well, I've got some of those I'm still working on too. So, but you got, and for corporation, you got until September 15th, and then you've got until October 15th for your personal returns. But extensions are not a negative thing, and they don't necessarily put you on the radar for the IRS, but they do give you some time to get your tax return prepared and get your records together. It doesn't discount you having to pay your taxes. Taxes are still due by your due dates of your tax return. All right, and if you didn't pay them and you owe, there could be penalties and interest, and we'll talk about that here shortly. Okay. Now, a question for you all is, you asked the question, I'm late, I missed my tax due date, and I didn't file an extension. Oops. Well, guess what? The IRS potentially has penalties that can apply to you. There's actually amounts. I'll give you some of the percentages because it calculates out pretty heftily. Luckily, I have not had anybody that's had a tax penalty. But the IRS has no way of knowing you're getting a refund unless you file a return. So your K-1s from your businesses, they see all that. They paid $5,000 worth of estimated taxes. Well, you're not even in the bracket. So in theory, you're on their radar. For each month or part of a month that the return is late. This your tax return, you have a penalty of potentially $250. Okay? The return more than 60 days after the due date. So you don't have to memorize things that could have hit you if you didn't get your tax. Look like a good brunch. Everybody got their taxes done, so these won't apply, so I won't get much more detail. But if you file penalty is a smaller of, guess what, $135 or 100% of the unpaid tax. So if you owed $1,000 and it's 60 days past the due date, you want to gamble? And the other item is generally the failure to pay penalty is 1/2 of 1% of your unpaid taxes for each month or part of the month remain unpaid. That amount is up to a maximum of 25% for you. Now, 1040 estimated tax payment coupons. From a personal standpoint, now a C corporation, estimated taxes. This is for individuals, and as I said, most of you all probably are the flow through to your individual tax returns, so you'd be using the Form 1040-ES. But this is for estimated tax payments, okay? The tax payments is that you have to estimate it's September 17th. The tax payment for 2012 is due January into December. IRS is benevolent to give you until January 15th to make your 2012 your fourth estimated tax payment. Doesn't mean you wait until January 15th. Or you've gotten W-2s for your every pay period, you have some taxes withheld all through Well, estimate. So just remember estimated tax. 40 ES, you print it out, it's a book, but it also tables in here how to calculate out where you're at in a way of potential net income, make your estimated payments based on that. But you're having a third party look at it. Don't wait until January and you determine you owe $10,000 and you hadn't made an estimated tax payment because IRS could IRS. Okay. The next item is the pension. That means what have you done? The thing I want to bring up, though, is how long. Good question. This is, and this is what the IRS says. As long as they may be needed for the administration, they say normally 3 years. Well, that's personal tax return. Okay, or a S corp. The C corp is separate, but those other three, even though they flow through to your personal tax return, okay, they have a lot longer retention for that return. Even though it's part of your personal return, it's a flow through. So that's just look at those as two returns in your filing system, okay, of how you maintain those. Normally, the recommendation is for personal returns, okay, is that you maintain the personal return. All right, the IRS says for 3 years. But in my case, I would recommend, and this is a recommendation only, but for normal, you maintain it for 7 years, your personal return, for an uncomplicated tax return. That means you don't have a lot of attachments, a lot of capital gains, you know, Schedule A that's got a lot of items on there, all right? Your Schedule C, Schedule E for rental property, that's a complicated return. That one you'd keep permanently. Your corporate tax returns, your corporate C Corp, S Corp, 1065, which is your partnership LLC, okay? You maintain those indefinitely, permanently also. As long as you've got the business out there, just remember to keep that. Because there are certain times that the IRS can come back to you to audit a tax return. Normally, it's 3 years for a personal return, okay? But it's 6 years if you did not report income and it's more than 25% underreported. So here you go, by keeping your personal return for 7 years, you're into that in case all of a sudden you forgot something or you really didn't get a 1099 or it got lost in the mail. Normally, you should know what you're expecting in income. You shouldn't have to wait to get a 1099 or whatever from an employer or another business or, you know, for amounts of revenue. You should know how much you earn. And the IRS does not discount just because you didn't receive it that you didn't claim it. Just remember that. So that's a failure to pay if you owe money on that amount. Okay. Now, here's a key item. This shouldn't apply to anybody in here, but there is no limit on the time limit for filing a fraudulent return. So just remember that. And here's one that's kind of interesting. If you have been in the stock market in the last few years, of course, you've seen the roller coaster ride we're on. Stock market's moving up a little bit at times, but I think, Mike, was it in early 2009 when the market really hit the bottom, right, for that? Well, some companies might never recover from that, but the IRS says you have 7 years to file a claim for a loss from worthless securities. Worthless means the company shut down, it's gone, period. All right, it doesn't exist, the stock's not even trading on the pink sheets, right, Mike? So just remember in your files to keep your records. Now, business records are very important to keep for other parts of your business, payroll, okay, other items in your records for business. All right? And most people now, I think, are getting smart to scan that information so you don't run out of room with paper over the years. But if you have paper, okay, great, but maintain it. Keep the corporate ones indefinitely, as I said earlier. Personal ones, 7 years for an uncomplicated return, and permanently for a complicated personal return. Okay? Okay, now a question I have for you. Have you all ever received an IRS notice? Who in here has received one of these letters from the IRS? Tom, okay, Michael. Did you enjoy seeing an envelope before you ever opened it from the Internal Revenue Service? Doesn't that make you feel great? Heartwarming, doesn't it, Tom? No, heart failure, more like it, right? The IRS is performing more and more audits by mail, okay? And that means by sending you a piece of paper in the mail, okay? The most common one that you see a lot of is called the CP 2000. And they normally issue these. You normally don't start seeing these until about a year after you filed your tax returns. They're finishing up 2010 right now with these notices. They do them in like 3 tranches or pieces. So they're finishing up the last group of mailing or close to it for 2010 because they have to wait to get all the matching documents that employers, companies submit, the 1099s, the W-2s, before they can start matching what you filed on your return. And once they start doing the matching, Big Brother computer starts running overtime.